We had a boost in unemployment numbers this morning. I'm Patrick Scott with the New York Times, here with Graham Boley. That follows a carnage we saw in the markets yesterday. Graham, is it more that there's contagion fears in Europe, or it's about a double-dip recession fear in the U.S.?
I think it's both. Certainly after the debt ceiling agreement was passed, people have suddenly focused on Europe. And there, the debt crisis has moved on from Greece to these much bigger economies of Italy and Spain. And the sense is that the packages and the system put in place by the European authorities just isn't enough to cope with this debt crisis in those countries, which is slowly kind of gathering momentum. Having said that, there is this fear in the US that the economy is not growing as fast as we had thought. Just at the time when the economy in the US needs intervention, the politicians in Washington are tying their hands and are actually saying we're going to cut spending, we're going to withdraw from the economy. While the Federal Reserve, and it meets next week, and all eyes will be on that now, is also sort of limited in what it can do. And there are questions about whether its big programs over the last year to inflate the economy have actually done any good.
So the markets today, we have futures are up because the unemployment numbers came out.
I think today's job numbers were much stronger than expected, and that's going to correct that slightly. But there's still this real divergence of opinion. Some people think the stock market will rebound as it did last year after a correction in the summer and end strongly. Others are much bearish and think it's sort of a downward from here as we kind of get used to this new normal of a slower economy.
The last time that we had a drop like we experienced on Thursday, 3 years ago, financial crisis, there are similarities, but there's also differences. What should we be thinking about right now?
I think it's bad, but it's not as bad as the financial crisis. We saw a drop in the stock market akin to what happened 3 years ago, but that's about pessimism about the economy. 3 years ago, we had a banking sector freezing up. That's not happening. Actually, the banking sector's okay. Credit markets here are okay. They're functioning. They haven't frozen. In Europe, there are signs of some stress, and that's why the European Central Bank yesterday began to lend more to banks to try and help those banks, because there are signs that they are struggling to find some sort of financing. So Europe has some sort of dynamics that people are saying are like a lame moment. I think it's still far from that.
We have people fleeing equities around the globe, and they're moving into instruments that they believe are safer, whether it's treasuries, US dollar, Swiss franc. Is that continuing? What's been the trend in that we've seen of late?
There's been a real flight to safety. Nervous investors, they've gone into US treasuries. Even just a week ago, actually, there was this worries about whether the US could default or lose its credit rating. That's changed completely. And this week, investors have piled into treasuries. Also, safe haven currencies, the Japanese yen and the Swiss franc. And that's causing problems because these currencies are really rising fast, and the central banks in these countries are having to act and intervene to kind of bring them back down again.
A lot of money is going into banks in cash. The question is, are they going to start charging people to keep money safely in the banks because you put it in there now for just about nothing or zero interest rates?
It is a problem for the economy if all this stays in cash, and if companies hoard cash and they don't start spending, amidst all this nervousness, if they don't put it to work, and that's what the economy needs.
Great, thanks. I'm Patrick Scott for the New York Times.